So I think every firm is looking for different things. I mean, maybe just taking a step back, here's the way I would think about private equity broadly, because private equity is a lot of different things. On the really small end, you've got venture capital. This is funding a business that may or may not have a viable business model, but it could wind up to be one of the biggest things ever. You've seen that in agencies a lot with insurtechs. I think we all would probably agree a lot of those insurtechs never really had business models. They take other people's rails or other things and they put a wrapper around it, but you never know. After venture might come something called growth equity. It might be a minority investment. It could be a majority investment, but this is a business that's still in growth mode. It may or may not be profitable, but it's probably at least like break even. The other end of the spectrum is leveraged buyout, which is growth is slower. Debt is being put on the business to make the acquisition. This could be a business that's 20 million in revenue or 2 billion, 20 billion in revenue, right? So within agency, like venture, outside of insurtech, there's just not often a lot of reason for it. You should use friends and family capital to build your business. So growth and leverage buyouts are really where you find a lot of it. So candidly, I don't know if you guys appreciate this because you're in the trench of agencies, but brokerages are one of those things that are so hot with private equity investors that as our firm, we mostly stay away from it. Like we admire the industry and we think we're eventually going to find a team that we back to go build a category killer. But on purely valuation, it's one of those industries that is like catnip for private equity folks, whether they're Midtown Manhattan, Chicago, or elsewhere. So why is that? Part of it is just because it's been a great asset class to invest in for decades. And unfortunately, many investors are momentum investors and they won't admit it. But the second piece, and this really gets to what's so great about the business, the revenue model is really premiums go up over time for all sorts of reasons. Commissions don't tend to go down much over time. So you have pretty good revenue growth and you have a super capital light business model. And you have one that is really just kind of ripe for consolidation. I mean, that's what Gallagher's been doing for 50 plus years. And it's just incredible to see what they've built that way. So there's a lot more nuance that goes into it, but the really simple answer is great revenue quality. It's very likely to grow and compound, and it's capital light. And you always have the opportunity to aggregate businesses around it.
Yeah, I love that. It's one of the oldest industries as well. So, I mean, it's like I'm sure a lot of the businesses you see are newer. You know, those are the exciting ones and those are the fun ones, but insurance is boring. Obviously, insurance is boring, but man, it's stood the test of time.
Fun is a great way to lose money in investing if you're not careful. You know, I mean, like we're always looking for things that are slow to change, and that's again one of the things that I think if you're in agencies day in and day out, you can underappreciate. Like people think AI is going to disrupt it. Not really. We can talk about why that is. The internet was going to disrupt it. Not really. Like at the end of the day, there's still so much